In another video, I look at the profit figures that investors can trust and the ones that I'd be a bit wary of made up by management. In this video, I want to look at a number that features quite heavily in analyst reports. Okay, the press also comment on it. It's not one that you'll find in a set of statutory accounts, but I would like to add it to the list of quite useful numbers used in the right hands in the right sector. It's called EBITDA. It's a variation of the standard operating profit number, and this video is all about where it comes from and why it's considered to be quite useful. Okay, so here's a basic profit statement. Now, without running through every part of it, you've got the usual statutory headings signed off by the auditors. You've got sales at the top, you've got the gross profit line, you've got the operating profit line, also known, by the way, as EBIT, earnings before interest and tax, which gives you a clue as to where EBITDA might come from in a moment. Then you've got your interest costs, your tax bill, and the result for the year. All right. Now, these two headings here, gross profit and operating profit, are useful and are widely used, quite rightly, by analysts, journalists, and so on. All right, gross profit is the heart of the business, reflected in a profit number and a profit margin. Before overheads, operating profit is basically the business activities, ignoring finance costs, which are simply a reflection of how the business is funded, not how it trades, and the tax bill, which is a function of tax rules, not really relevant to deciding how profitable the business is from its trading activities. So there are good reasons to look at both the gross profit and gross profit margin, operating profit and operating profit margin. So what's EBITDA all about? EBITDA is about saying, well, actually, yes, this is an important number, but it suffers. It suffers from one flaw, and that is it is stated after a couple of quite subjective, dodgy costs have been removed. One's known as depreciation, the other's known as amortization. So if we add those back, i.e. strip out their effect, we'll get to a profit figure that can be trusted, a profit figure that is not influenced by a rather strange accounting quirk. It's called EBITDA. Now, what is that accounting quirk? Well, to create EBITDA, first of all, you start with the operating profit number. Now, most of you won't have to do this at home, but it's just to give you a flavour as to where it comes from. Add back the annual depreciation expense and add back the annual amortization charge. Hence, EBITDA, all right? Earnings before interest, tax, depreciation and amortization, all right? Or earnings before dodgy items, if you like. Now, what is suspicious about depreciation? Just by the way, depreciation is the term that we use in the UK for long-term assets you can kick, plant machinery and so on, amortization for long-term assets that you can't, so patents, licenses and goodwill and so on. What is it? Depreciation is the director's way of dealing with the cost of assets that are used year in, year out in the business. If you buy an asset for, let's say, £100,000, rather than dumping that cost against year one's profit, given the asset's going to be used over maybe 10 years here, what the directors actually do is they knock off a proportion of the asset's cost against profits each year. How do they know what proportion to knock off? Well, essentially they decide. They decide how long the asset's going to last. They divide the original cost over that useful economic life, as it's called, and the result is depreciation. So if you're looking at the asset at book value in the balance sheet, you get a kind of steady drop-off, as in this case, £10,000 of depreciation is charged against each year's profit and loss account. And analysts often don't like this because they say, well, who decides the 10 years and therefore the £10,000? Why not 20 years, which would halve the depreciation expense? Why not 5 years, which would double it? And everything you do to depreciation, you are doing to operating profit and therefore changing the way that the company presents its results. So essentially, because of some of these assumptions that the directors have to make to arrive at depreciation or an amortization expense, including how long the asset will last, what it'll be worth when they've finished with it, in sales terms, and even what method they're going to use, all right, to actually depreciate the asset over its useful economic life. So just to give you a flavour for that, this isn't an accounting video, but a flavour for that. Straight line has that sort of impact. There is another method called reducing balance that basically applies a percentage to the book value of the asset. The effect is to kind of create almost a decline more like that, if you like. More depreciation in the early years, less in the later years. The point is all the time changing the profit figure that's being recorded. Because of these things, quite a few analysts like to say, oh, it's all too complicated. Don't like the look of this. It sounds dodgy, sounds objective, so let's take it out. Let's simply take it out. If you're going to do that, by the way, you can restate operating profit and then create something called an EBITDA margin. So I'm going to finish by just looking at that. There is my basic profit statement with the operating profit line in there. What would I do to turn that into EBITDA? Well, what I'd do is I'd go hunting around for a depreciation charge and an amortization charge. There is a note to the accounts for those people interested that tells you what those amounts were. Here, 25 and 20 million respectively, and I'd add them back. Easy for me to say. So I'd take the 120, add back 20, add back 25. So EBITDA is now 165 million. By adding items back that have previously been charged, I'm increasing the number, and my EBITDA margin is 41%. That is the 165 as a percentage of sales, and that is also higher than my existing growth operating profit margin, 120 over 400 as a percentage. All right. Now, that's the basics of how EBITDA is calculated. Is it a perfect number? No. Don't go away from this video thinking, brilliant, from now on I will always substitute operating profit for EBITDA. And here's the reason. All right. Although this number does allow you to more easily compare perhaps industries with different levels of capital intensity. All right, some critics would say just be careful because you are looking at a profit number that, yes, might be a bit closer to cash flow, which is the main argument for it, but also strips away some very important costs. Earnings before interest, for example. All right, so you're not deducting interest on debt. All right, and you're also not deducting the depreciation of fixed assets. So let me paint you a picture here. Imagine you're trying to expand a telecoms firm really quickly. You're buying loads of fixed assets to do so. You're funding it all with debt, so you're taking on balance sheet risks. You're growing fast, but you're increasing balance sheet risk, but top line sales are going up and EBITDA is also going up and your remuneration is linked to EBITDA. Marvellous. But do we want to invest ultimately in companies that grow at any cost? Not necessarily. I'll leave you with that thought. Quite a lot of ground covered there. Any questions or comments as usual, please contact me at editor@killick.com.